So if you guys are tuning in, feel free to share the Zoom link with a friend or a family member. I know a lot of people have been talking about elections. I think some people might be sick about talking about elections because of how long this has been going on, but feel free to invite a friend or a family member or even a business colleague that might appreciate this discussion. We appreciate the connections. But I will kick us off since we have a packed schedule and only an hour here total. So welcome everybody. I am Samir. I am leading strategic growth here at Wealth, Thrive, and Freedom Family Office. And we're about to peel back the layers on what could quite possibly be one of the most pivotal election cycles we've ever seen. It's been sort of remarkable just to see where it started to where it is. And, if just shaking things up, but regardless of where you stand politically, there's definitely one thing that's clear. And we can go to the next slide. So again, regardless where you stand, Trump is stepping into Oval Office. He brings with him a mix of hard-hitting policies, a lot of promises, and different strategies. And it's kind of like being on a roller coaster. You might love the rush of the roller coaster or be scared of the twists and turns that come with it. But we're facing potential tax overhauls, extending corporate tax cuts, dialing up incentives for U.S. manufacturing. And obviously the big talk of the town has been tariffs, which our experts here are going to cover shortly. But when it comes to navigating the waters with this, you sort of have a couple options. You can either just push along with it and just see as it breaks down on CNBC, or you can kind of control the ship, and you're doing that with listening to talks like we're doing today. So right now, we're going to break down trade, tax policy, what this could mean for the M&A market if you're thinking about potentially exiting your business, if you're listening in as a business owner. But I want you to think about it. If you had the chance to best position yourself, what are some questions that you would want to ask our team here to help sort of navigate the next 4 years? In a lot of ways, of course, based on the stock market results over the last week, the Trump win is favorable for business owners, high net worth entrepreneurs, and more. And I will just kick us off before starting. I think the best foundation we can do is giving it to Peter to just talk about a few of the policies before we dive into the actual Thrive Talk. Thanks, everyone.
Thank you, Samir. So what we've put on this page is, I would say, two things. One, while Trump has been elected, it was a pretty sweeping election. The House is still a little bit in doubt, and maybe more in doubt because Trump is starting to appoint people from the House to his leadership team, which, at least in the short run, takes numbers away. And I think one of our overall messages is don't necessarily take precipitous action, because I'm not sure that the whole scene has been clarified. But right here is a list of all of Trump and his team's proposals in a variety of areas. If you want to, take a picture of this, or we'll send it to you afterwards. But I think part of what you want to do is think about your own situation, think about your business, and go down through a checklist like this to see whether Trump's tax proposals for individuals and corporations look favorable or unfavorable for your specific situation. Tariffs might be a classic example. They could be neutral for some industries, but potentially very negative for other industries. So I think we'd encourage everybody. We're going to try and unpack a lot of what's on this page, but you want to take a little time to think through how at least what Trump wants to do could affect you either positively or negatively. So obviously, it's at the top of this list. Part of the core of Trump's proposals relate to taxes. And so Noah's going to give us a little bit of an overview of what is on the table and maybe looks likely to occur, and how you might think about that as we, turn the page into 2025. So
Go to the next slide.
Yeah, so the biggest, I would say, action that you're going to take right now when it comes to taxes is an evaluation of what are the things you might want to do in 2024 before year end versus waiting until 2025 if you have that option. And with respect to what we anticipate is that the Tax Cut and Jobs Act, which President Trump had put into law, many of those items are set to sunset. And his policy position is that he wants to extend all of them and kind of bring them back into law. That's going to cost money. And one of the challenges that I see between what Trump is saying with respect to taxes and what Elon Musk has been saying with respect to reduction of cost and really reduction of our deficit is that they're in contrast with one another. So Trump's talking about reducing taxes, which would likely have a reduction in the receipts, the gross receipts of the federal government. And so if we're going to have less receipts, yes, we might be able to pair them with less expenses, but it's going to be tough math to make the budget balance. When it comes to the reduction of the corporate tax rate, where Trump has been focused is on U.S. manufacturers. We still have a very low corporate tax rate at 21% federally. And in fact, before the election, when we set up WealthThrive, we actually set that up as a C corporation. And there was a bit of uncertainty in that if Harris were elected, she was proposing a 28% corporate tax. But, I think we had the confidence that in any event, a C corporation was a better structure for us. And so we didn't let that influence the ultimate decision. But for those of you that are deciding between what corporate entities you're going to utilize, for all the reasons that a C corporation may have made sense in 2024, you can have confidence in making that same choice going into 2025. That there's unlikely to be an increase in the corporate tax rate. And in fact, if you have a manufacturing business, you may want to evaluate forming a C corporation because you're likely going to benefit from a lower 15% corporate tax rate. The other interesting component of the Tax Cut and Jobs Act, which we are likely to see reinstated, is bonus depreciation and accelerated depreciation and some other items where in the benefit is that you get a reduction of income in the year of purchase or acquisition of certain property versus right now that there's a phase out to those limits. And so we most often see this in our business related to real estate acquisitions. So often, for those of you that don't know, we're buying, family apartment buildings, other real estate. And when we buy those assets, we're typically trying to depreciate them as quickly as we can. Over the last 3 years, the amount of depreciation that we were able to benefit from in the first year declined considerably from 100% depreciation to 80% to 60%. It's going down to 40%. And so if Trump brings it back to 100%, that will make the investment in certain assets more attractive. So that could be real estate assets, but it could also be business assets, and it could also include the acquisition of other companies. So if you're debating whether or not to make an investment in equipment or another type of depreciating asset in your business in 2024, if it's not urgent and you don't necessarily need the deduction immediately, you may benefit from waiting until January 1st of 2025 and acquiring that equipment. Again, a bit of a risk play because the current rules are set to go from 60% to 40% next year for certain assets. The estate tax is scheduled to change. The estate tax exemption, the credit amount, is currently at 14 million thereabouts for 2025. And it's scheduled to go down to 7 million for 2026. What I would say is that while President Trump has made some comments about a repeal of the estate tax reduction, that doesn't seem very likely in any event. And what would be most likely is a continuation of the current policy with the higher exemption amount. So instead of the sunset being at 7 million on January 1st of 26, continuing with current law where the $14 million exemption would continue to be indexed to inflation. I think irrespective of where that trend goes, one of the things that we always encourage is to pay attention to your own individual estate plan, because estate taxes are an optional tax. You do not need to pay them if you're willing to plan around them. And for those of you that have estates that may be greater than the $7 million exemption, or maybe even greater than the $14 million per person exemption, we just encourage you to do your planning now, because in any environment, the estate tax code can change. And so most people aren't planning to die during the next administration. Maybe you're not even planning to die in the administration that would come after that. And so we don't know what the estate tax law will be at your death, but what we can do is put a plan together so that you wouldn't pay any estate tax no matter when you die. And the rules right now are the best they've been to enable you to do that. There's also been a lot of talk by President Trump about eliminating tax on tips and even potentially tax on overtime pay. Again, I'm particularly personally suspect of how this could get implemented. There are really, so far, 3 different ways that have been discussed as the structural way to eliminate this tax. One is to make tips not reportable as income. And again, I think that the devil's always in the detail when it comes to tax policy, because, perhaps I just start tipping Samir versus paying him a salary, right? Same with tax on overtime. If it's overtime pay is not included in income, well, maybe we'll have full-time wages for certain employees, and then we'll pay them a lot of overtime wages. So I'll wait and see what happens there. But another way that they may include the elimination of tax on tips and overtime is through a deduction. So you would still receive all that income, you would still report that income, and then you'd receive a deduction against your income to reduce your total taxable income. And that would probably be more likely, and the most likely way to address it would be with some type of deduction limit. So maybe the first $3,000 or $5,000 worth of tax or overtime tip or overtime income, you'd be able to have a deduction against it, and therefore they could provide a benefit to certain wage earners that are receiving overtime or tips, but they can cap the cost. And if many of those taxpayers are at the 24 or lower percent tax bracket, right, they could kind of quantify how much that would cost them, and they would have a less of policy maneuvering or loopholes that they'd be creating for overtime or tip pay that people might otherwise structure around. And then, of course, the third thing might just be a simple credit. So every taxpayer that reports tips or overtime pay could have a $1,000 credit applied to their return, as an example. And that would be another way to structurally enable that to take place. So we'll wait and see. But one of the areas that Trump's talked about a lot, which was actually a policy that he had included, is the SALT, which is the state and local tax limit. So for those of you that have state tax or real estate tax that in total exceeded $10,000, you may have noticed the last few years the maximum deduction for those items was $10,000. So if you're like me, I think my real estate tax bill, which is on my desk, is $21,000 for next year. I would only be allowed to deduct $10,000 of it. But the reason my real estate tax bill is on my desk is because I'm not going to pay it in 2024. The state of Florida allows you to basically just pay a slightly greater amount each month until March of the following year. And so what I am planning to do is incur the additional cost, essentially an interest amount on my tax bill. And let me see if we get to March and perhaps the payment of your real estate tax will now be unlimited in 2025, and I'll be able to benefit from that 100% of that deduction. And for 2024, I would still itemize my deductions based on my charitable contributions, my mortgage interest, and other items. So hopefully that's kind of a nice broad overview of a few things that you might want to take a look at in addition to the list we shared.
Yeah, thanks, Noah. And I see that we have a question in from Jonathan, which is a great question. That's if everyone can just put their questions in the chat like that, we're going to have a full dedicated section for Q&A after Kyle finishes up. So thanks for the question, Jonathan. We are going to answer that. And if anyone else has questions, just like Jonathan, please post it in there. But thanks for sharing. No, I think generally the consensus is the tax side of things, it's very favorable for business owners and entrepreneurs. And it looks like with this administration, generally folks are bullish on what that means. Another side that looks very favorable within the Trump administration is on exit planning. So if you thought about selling your business within the last 4 years and maybe hesitated, this could be a unique window in the next 4 years in terms of M&A activity and selling your business. And Peter is actually going to cover that. So I will pass it over to Peter.
Sure. So I think, thanks, Samir. I think you captured the high level, which is the halo effect of the Trump policies is overall positive for business, which probably means it's overall positive for the valuation of businesses. So all the things that Noah just talked about, pro-business tax reductions, those could drive higher valuations if, and I think this is a little bit more of an if interest rates stay low or lower. Anybody in the audience who tried to sell a business, say in the last 18 months, the very precipitous rise in interest rates that occurred in that time period pretty much like dried up the M&A activity in many, many industries. It started to thaw out a little bit. We see some more activity. I think the takeaway there would be, it's another version of what Noah is saying. I think we've got a positive background, which could get better. So, you might want to bide your time. I would say going back to where I started, though, there are potentially some industry groups that might be negatively affected by some of Trump's policies, especially on the tariff side. So you might want to, watch that carefully to see, how that might impact it. I think maybe the most important thing in this area to think about and plan for is there is no proposal to reduce the capital gains tax rate. And so if you're a business owner, you started a business from scratch, you bootstrapped it, it grew tremendously, you could end up paying a capital gains tax anywhere to 23.8%. I'm working on a case right now in California where that could be north of 40%. So there is a little, I haven't read too much about this, but something that occurred to me right now, in many cases, the capital gains tax rate is the 20% federal rate plus the 3.8% Obamacare tax. One of Trump's proposals is to repeal Obamacare. I wouldn't hold out a whole lot of hope for that, but maybe that would result in some reduction. Most of the states that have high state capital gains taxes are blue states, so they are not likely to reduce their capital gains tax rate. And so the point about that is, I think, even though there may be a positive environment for selling a business, and that may translate into higher valuations, you're still going to face the possibility of paying a big capital gains tax rate. And topic for another day, but we have some tremendous strategies that we could share with you to reduce and in certain cases potentially even eliminate the capital gains tax on the sale of a business. The key is to start early. Some of those strategies you cannot implement in a month before the closing. So really something that we harp on all the time is that we see business owners not prepare effectively in advance for their sale. And I would say if we're entering potentially a time period where your valuation might be higher because of this pro-business environment, all the more reason to start early and try and put in place some of the structures that could minimize the tax on the sale of your business. So
I'd add, Peter, that right now in private equity, they have what's called the most dry powder ever. And so there's multiple trillions of dollars that have been pledged to funds to go acquire businesses, some of which they're sitting on already, some of which they're able to call that capital from investors. And they've been kind of waiting. So they've accumulated all this cash. There's a lot of pressure on them to buy, because if they don't buy and they give up that capital commitment from their investors, they're not going to have fees to charge on those assets. And so, I think there's the makings of a nice little bull run in the M&A marketplace,
Right.
where we could have some multiple expansion and a lot of deal activity.
So I like the phrase bull run, which kind of will be a nice transition to Kyle Cain, our CIO. For those of you who have been watching since Trump was elected 7 days ago, I guess, the market's up north of 5%. Historically, in the year after an election, Kyle will go into this in more detail, but it's been up as much as 15 to 20%. So that's a backdrop probably for some advantage to be taken in the next year. The obvious question is, where are the advantages? So I'm going to turn it over to Kyle, who will unpack that in some nice detail, and hopefully give you all some good advice about, what to do with your funds in the next, 1 to 4 years.
Yeah, thank you. I guess that's the best place to start it off, is that if you've been one of my clients, or if you just had your outside portfolios, it's been a pretty good year for you. For an election year, this has been the best election year stock market performance since the 1930s, right? The day after the election was the best one day after election performance ever. The second best was actually 2020 though. So again, doesn't necessarily matter sometimes who's in the seat. It just matters on where you're coming from and the economic momentum behind it. So, so let's talk a little bit about, set of where we are and the Trump trade. A lot of people are, did I miss it? Some of those of you who have been sitting on the sideline, like as Peter said, it's, just since the election, right? The markets are up 27% year to date as of now. Before the election was like 22. So since the election, S&P's up about 5%. And then if you start to look at the Trump trade, which we'll talk about here and break down a little bit further, small caps are up about 10%. Financials up, 8 to 10%. Industrials up, 7-8%. Banks specifically up 12 to 15%. Private prisons, we got into the deportation, and we'll talk about that. Some of those stocks are up 70-80%. And then also part of it is interest rates are up. Interest rates, especially since, early September, 10-year was around 3.6. Now, today, I know it was up quite a bit more. We're around the 4.4 to 4.5% range. So, what is this? All does this mean? Again, have we missed it? What areas should do better than others? And I guess to answer the first thing to Peter's point is, we're only up about 5% since the election. Historically, like you said, it's, up 17-18%. You look back the past 40 years or the past 10 elections over the next year, right? Like the uncertainty, markets don't like uncertainty, and the uncertainty of the administration is over. Yes, we still don't know the House, completely. And there still is plenty of uncertainties on actually what policies are going to be implemented, but at least the uncertainty of, who's sitting in the seat is over with, and markets like that. Now we can start to focus on what are the policies, where is the economy at, and at the end of the day, right? Let's go back to what drives. Besides, we always say that you should invest regardless who's in office, right? Whatever your political leaning is, you should invest. Markets go up under both administrations, right? We've seen this time and time again. So time in the market beats timing the markets. However, right, good thing about working at a boutique firm like we are, we can put our best ideas into place. So we can actually, significantly put, depending on who's in office, certain asset allocations, certain our best ideas get implemented right away. So, So let's kind of break it down, right? Like, what is actually going to happen? What policies are going to get forth? Again, with a sweep, more than likely, as Noah, talked about, we'll get an extension of, the taxes. There'll be some cuts, marginally with SALT and, some other things that could potentially happen. So tax environment's going to be good. How does that help? Well, mega cap stocks, right? As we know, the big Mag 7 taxes, they pay already extremely low in tax rates with the way they're structured. Small cap, small business owners, they're the ones, hurt by taxation. So a more favorable environment is good for small cap stocks. Healthcare, real estate, some of these are the higher taxation industries that should do well. If we were able to pass something to get, 15%, corporate tax rates on, American manufacturers and things like that, the estimate gains is about 4%, earnings per share gains if that were to actually be able to take place. The next thing obviously everyone talks about is tariffs, right? What can potentially happen on that front, and what would that mean for the economy? Well, again, no one knows exactly, how this is going to play out. But I would say if you start looking at the makeup of Congress, we've got deficit hawks on the Republican side. We've got, plenty of Republicans who vocalize that they don't like tariffs. So to see just a blanket across the board, all of, his tax cuts and all the 10%, broad stroke tariffs and 60% against China isn't likely. I'm not saying that it can't happen, but it isn't likely. We'll probably see, again, use more, and that's what the markets are pricing in right now too, right? Is that, it's going to be more of the pro-growth agenda and a little bit less of the full, gauntlet of deportation and tariffs. So, that being said though, right, there probably is likely to be increased export controls, increased tariffs. That impacts, certain sectors more than others, of course, right? Anyone that's, go back to that small cap thesis, right, of why small caps have done so well. They're historically a little bit more domestic, right, less multinational. Even though, again, if you kind of really look at the, the real breakup, there still is plenty of, plenty of exports that happen in small caps, but overall, it's a more domestic based, sector to invest in. So they should do well. Certain areas, of course, appliances, certain technological aspects, plenty of things that are going to be hit, retailers, et cetera, potentially hit by the tariffs. But, here's where we kind of go into is what does that mean for the markets? And I'll sort of break down each one of these things a little bit further, but the tax cuts aren't going to happen until 2026, right? It's very unlikely that Trump in 2025, as soon as he comes in, just hits the market with tariffs, which is going to be a potential, estimate if he did do the full gauntlet, right? Somewhere between, they're estimated between 0.5% and 1.4% GDP hit. He's unlikely to do that, right? Trump cares about the stock market. He cares, about like the way it looks. And so he would likely not hit that in 2025, knowing that a lot of the tax benefits aren't going to come till 2026. So it's not something that we should see as an immediate impact anyways. It's going to be more thoughtfully debated and more tactically enforced with a lot, so it's either going to be more directed, specific tariffs that are implemented, or a 10, which I don't think is going to happen either, but if it was a 10% across the board, there's going to be a million exemptions, right? They're going to exempt everything, from all these different companies. Apple's going to get exempted, all these things that potentially could be really market moving. He's going to put, exemptions in there. Let me see, what else? The immigration, right? Immigration is another hot button that is talked. I mean, certainly as soon as he comes in, the main things he's going to be able to do when he gets in office is, kind of shut down the border, change sort of the definition and certain policies around asylum seekers, and deregulation. He's probably going to move pretty quickly on deregulation. Certain areas obviously that are going to benefit from the deregulation, financials, hence why banks are up so much. Again, small caps, going back to that, you hear that many times, why small caps are up so much. One of the biggest costs for small businesses is compliance, right? It's kind of, a huge headwind to them, all the regulatory compliance that they have to deal with. Less than that is a pro for small, a benefit to small caps. Let me see what else. The deregulation, hence crypto is doing, well, all the rhetoric, with Trump with crypto, but also the deregulation. I think, obviously deregulation energy, we can talk about the energy sector if anyone's, interested, but AI, right? AI, probably be less regulation that, even if there should be, regulation put on AI, there's going to be less of that implemented in the next 4 years. So that train is still headed in the right direction. Of course, semiconductors, could be impacted quite a bit by tariffs, but just back to that point of, the crypto deregulations, more crypto mining is good for semiconductors. So there's as we kind of talk about each of these sectors, small caps, energy, healthcare, et cetera, there's pros and cons to all of them. The overall thesis, though, is again a pro-growth, deregulation, more pointed, sort of selection on tariffs. So I was going back to immigration, right? So again, if we kind of look at, some of the rhetoric of deporting 11 million, immigrants, not likely to happen. The cost is just way too high. Logistically, it's not gonna work. Even if you look at, that was a lot of his, he ran on that a lot in his last presidency. And if you really look at the numbers, it was only a few 100,000 that were deported, per year, kind of in line with what Obama, deportation record was as well. However, we will see a slowdown, right, in population growth. We are going to see, right, a closing of the border. We're going to see less, immigrants coming into the country. That, again, whether or not how you view that around the safety of our country and things like that, less population growth does slow down, consumption, does slow down consumer spending, does slow, economic growth. Potentially, right, is an inflationary aspect. If we do start to see again some more deportation, things like that, right? That's the cheap labor. Hurts hospitality, hurts agriculture, hurts construction. That's all you have to now fill the gap with other workers, pay them more. That's inflationary, right? So that goes back to why interest rates are moving higher. Is they start to see, tariffs. They start to see, deportation. They start to see all these things. The deficit expansion. If you're going to try to do more tax cuts, where are you going to? There's not enough places. Look at Musk saying he's going to cut $2 trillion. In spending. There's nowhere for him that to be cut. Right. There are certain things they could do, and I could go into the areas where they likely get cut, but it's not going to happen. So it could potentially be inflationary. Tariffs, though, keep in mind that it is technically, right, it's not really inflationary. It's more like a one-time hit, right? It's kind of like a one-time increase. It's not year over year inflationary unless you keep increasing tariffs every year. And again, we go a tit for tat and go into a crazy trade war, which isn't likely to be the case. So, interest rates could, be an interesting thing to watch. And like I said, Trump cares about the markets. He cares about, and if you look at kind of what happened in Europe and things like that, where, right, and you kind of probably read in the news about bond vigilantes, right? If the deficit gets completely out of control, the bond market kind of push back against it and start pushing interest rates really, high. And that's not good for anyone, right? Which went back to small caps don't like it. No one likes significantly higher interest rates. And Trump has ran on he wants lower rates, right? So again, I think at we could go into more sectors specifically, but the broad case is a lot of that stuff he has people, smart people talking in his ear, letting him know that you can't do everything. It has to be more, more kind of more specific policies brought in over time, still pro growth, right? So at the end of the day, what am I doing? What am I for clients, right? Is immediately after the election, increase small caps, decreased international. Again, internet. There's a reason to stay diversified, and I can go into those reasons, like where you might not want to get rid of completely all of your international exposure. It is super cheap. And again, there's some other things, but significantly, we were already significantly underweight. International went even more. Overweight, small caps, overweight financials, overweight, and I'm kind of neutral on industrials. We were already overweight, but I'm keeping that overweight a little bit. Healthcare, energy, those are, again, big debated sectors. I'm kind of neutral on them. There's some benefits. Energy has rallied about 5% since Trump election. However, everyone knows that, right? They think there's going to be significant more production. However, if you really look at, all the drilling leases and I think there's going to be there's 54. What is it? There's, something like 5,700 drilling permits pending. And if Trump comes in, all those might get approved. But there's already 7,000 approved permits that they're not using right now, right? So we are going to see more production that could push oil prices down, hence why it's neutral, right? There's pros and cons to the energy industry. Deregulation is going to certainly, save them lots of expenses. But I think big tech has already started to rally around alternative energy. So we saw a big sell-off in alternative energy. And I'm not necessarily buying, a huge buyer now, but it may be something to watch because it's not going anywhere. So if you can get it at a discount, might make sense to do a longer term play with alternative energy, start picking it up with a sell off there.
Kyle, what about if I'm in the audience and I'm a big time just S&P 500 guy, I just buy the index, the SPY, the DIA, whatever. What would you say for someone that is just passive? What should they be doing?
Well, so here's the main thing, right? Is we still, we still believe in having passive index, getting exposure to it. We have a big chunk of that in our portfolios. However, right, if you kind of look at the past 10 years, even the setup has been very much pro large cap. The bigger get, the larger get larger. We look at earnings growth over the past couple of years. It's pretty much came straight from the Mag 7. That's about to change, right? It is about to change. They're still not saying that they can't still keep going up. However, obviously they're trading in extremely high multiples for that expected future growth. Whereas, I mentioned small caps many times here and again, increased M&A, more deregulation, right? Potentially lower taxes. It's just an environment. Small caps are extremely cheap. If just 1% of money, and we know there's a bunch of cash sitting on the sidelines, but even forget about that. Even just 1% people got on the small cap train a little bit. 1% came out of large cap stocks and into small cap stocks. That's a 20% growth. We just see small cap stocks jump 20% just from that, and they still be cheap. So again, there's risk there. We could be still too early for the small cap earnings revival, but those earnings are expected to start to grow faster than the Mag 7 here in the future. So just having that index exposure, just the S&P, gives you a lot of the risk that NVIDIA doesn't live up to the hype, that tariffs are, enacted and Apple gets hurt really bad. And those, again, their earnings don't even have to drop. Just the amount people are willing to pay for the future growth drops, right? The S&P could drop where the rest of the economy still does well and the rest of the stocks does well. So adding some more diversified exposure, having some more active management that can, play these things will likely likely over the next decade, let's say, outperform just the S&P 500.
Right. That's helpful. Thanks for sharing that. I think I always enjoy listening to Kyle's insights. He just has a wealth of knowledge, and he could probably go on for 5 hours about the stock market. He's such an expert in it. So I appreciate the insights. I think what we're going to do now is transition into Q&A. So if we want to put the deck back up just so we can get questions. So I have a couple questions here, and I'm going to just filter it based on which expert the question is about. But feel free to raise your hand as well. We would welcome you to come join us on stage. If you want to ask a question, all you have to do is click in the React, raise your hand. And if you raise your hand, our team will bring you up and you can come join us live and ask the question live. It would be great to have someone do that. But no, I had a question for you actually. So C Corp was mentioned about potential positive impacts on the taxes. Would those also apply to LLCs with S Corp election?
Not under the current rule setting. So right now, those LLCs with the S Corp election, they're passing through that income to the owner, where there's one layer of taxation versus the C corporations, they have two layers of taxation. You have a corporate tax, which is what Trump is proposing, gets reduced from 20% to 15% if you're manufacturing. And then the second layer is a dividend tax. So after the C corporation pays its tax, it decides what to do with its profit after tax. It can either retain that, in which case there's no additional tax and it can invest for future growth. Or if it elects to distribute that profit, it's called a dividend. And then the owner of the stock pays a dividend tax. So that's the second layer of the C Corp tax. And there hasn't been any talk of reducing the dividend tax rate that I've seen anywhere either.
Got it. Thanks. That's great to know. We had another question from Bill Williams, which was Donald Trump says he wants more control over the Fed. What, if any, effect will that have in the economy, stocks, bonds overall? I'll ask you, Kyle.
So let's just say, I mean, whether or not whoever he appoints as the next, right? He's not going to fire Powell. He might have someone just kind of appoint them very early to try to, persuade the next chair. However, right now, Powell could be persuaded, and the whole entire FOMC could be persuaded by the presidency. However, they know they have a mandate that's supposed to be completely, that they're a completely independent body, and I think that continues, right? I don't think that they're, as much as a president may be in their ear, and they may feel they don't have job security, right? As of right now, it doesn't seem like a president can fire the Fed chair, so they're likely to continue that mandate of being completely independent. I don't think many, again, other Republicans would be, they're more pro-independence as well, right? So I think at the end of the day, it's not something that likely is going to have much of an impact on Fed policy, rather than what actually what the Fed or what the president does, what policies is put into place, what Congress does is going to impact the Fed's decision, not who's in office and not them having direct control.
Right. And I know, Powell, we saw the rate cut last Thursday. Do you envision that rates will continue to go down?
So the main thing is this, right? Is we know that, again, some of the stuff that we just said, some of Trump's policies could be a little bit inflationary, but the Fed can't act on what the potential inflationary impacts could be because they don't know what policies are going to be implemented either. The Fed thinks right now that the rate at 4.5, 4 3/4 is restrictive. So as long as they think it's restrictive, the job market continues to hold up where it is. We may see some sticky inflation numbers. We got inflation coming out, here this week, right? That could impact the future rate cuts, and that's what the bond market has been telling us too. Why interest rates have gone up. However, more than likely, we'll still see some more cuts because they believe we're restrictive, right? So they think another quarter point, we're still going to be restrictive. They're going to continue doing that until something changes, inflation, spikes back up, or the economy weakens too much, and they're going to continue the pace of it. It might slow down, whereas at the beginning, everyone was thinking there's going to be a quarter point at every single meeting. I would say, unless the data between now and December is really unexpected, we'll probably get another quarter point, and then maybe a pause, right? And then maybe a pause, because no one knows where that neutral rate is, and then we might move to like a quarter, every quarter do a rate cut instead of every single meeting do a rate cut. So at the end of the day, yes, I still think as of right now, we're on a trajectory for lower inflation, still sustained growth, still lower interest rates. And that's, kind of the path, just maybe not, right? As long as the economy keeps growing like it is at above kind of, that normal, they say 2% GDP is sort of normal growth. Anything above that, which we've had for 3 quarters in a row now, is beyond, expected growth. So maybe the neutral rate is higher. Maybe it's, instead of 3%, maybe it's closer to 4%. That has bigger implications. But again, we're at 4.5 to 4 3/4. We still have room to come down. So the answer is yes. We'll still continue to see the Fed cut rates here coming into next year. How many, we don't know. But
yeah, I think it's music to a lot of people's ears after dealing with such a high interest rate environment for just the longest period here recently. Obviously,
which I'll just be the plug, right? Of again, those who thought that they're might have missed out on the rally. Like I said, I don't think it's necessarily done. I think we're gonna actually potentially, again, there's always going to be certain sell-offs. I would use any sell-off. They're probably not going to be large as a buying opportunity, regardless. It's hard to time that. Cash rates are going to start going down. And I said, the Fed is going to cut. Cash rates are going to start going down. I don't know exactly where the 10-year, the longer term bond is going to end up, but 4.5% is a relatively attractive place to lock in on the bond market. We're doing a lot of shorter term, kind of like floating rate, high yield. I go into the high yield market, the pros and cons there, but a lot of shorter term high yield right now, just in case the 10-year, goes up a little bit further, but likely it makes sense to get off the sidelines, as your cash is going to start going down, and likely into the stock market. And again, there's plenty of areas to explore.
Yeah, no, that makes sense. Thanks, Kyle. One thing that has been big from this campaign and even in Trump's last presidency was the whole conversation about tariffs, which our team touched on. With obviously it looks like there is the potential for increasing tariffs, and that's going to target trade partners, and a lot of businesses might have a lot of their supply chain offshore. So this question is really for anyone, but what are the pros and cons, maybe even for of just reshoring operations given the Trump administration? Should you be concerned if you're a business that has operations that you're offshoring things in China and other countries?
Yeah, we have one of our clients, and he kind of was bracing for impact during this election, and unfortunately his manufacturing's in China, and he's now scared that he's not going to be able to push through those price increases to his ultimate customers. And to onshore that activity for him would be more costly than simply having paying the tariff. So he kind of has to pay the tariff, through his supply chain, because bringing it to America would still be more costly. And I think the evaluation that every entrepreneur should be doing is looking at their supply chain, looking at where they're sourcing. And I think a lot of people started getting into this habit more frequently once COVID broke out, because that was a black swan event that made people think, wait a minute, if I'm single source of supply in a single region or a single country, I've got risks that I probably wasn't thinking about. And so it's time to do that exercise again, determine if you can be sourcing products from a country that's more likely to have a 10% tariff or potentially no tariff, if you're onshoring domestically, and if that might be able to get you that 15% corporate tax rate, maybe between the reduction in tax rate and the increase in offshore cost, the math can work out for you to bring those jobs back to America. I don't have a high degree of confidence that those policies are going to lead to an American manufacturing boom, but they will definitely move the needle in certain places and have an impact with, certain industries, certain supply chains. So I think we'll have to wait and see where it takes place.
Yeah, and thanks for using the actual real-time example. It shows that this is something, although Trump is very favorable from a tax perspective and corporate tax cuts, the tariffs are a real problem to present, especially if you think about selling your business and half of your business is done overseas. That impacts valuations. So it's something serious to consider. We had a question come in here from Alan, and I'll ask this to you, Kyle, with the Trump pro Bitcoin stance, and obviously Bitcoin has been all over the news. I think it broke over 87 or 88,000. It was the new high. But with the possibility of the US and other countries stockpiling Bitcoin as a strategic reserve, as well as Michael Saylor's MicroStrategy buying billions, the question is, how high do you think Bitcoin can go? And two, what percent of the portfolio should be allocated to Bitcoin? And I'll throw in something there. Do you allocate Bitcoin into client portfolios today?
So I'll answer that last one first. No, currently we don't. Not that, again, I'm not bullish on Bitcoin as I am. We just think that that's, again, a better play on, right, where my expertise is going to be more on, right, something that has fundamentals, right? Look at the cash flow, look at its earnings, what it's going to do. Bitcoin is a little bit more of right, it's more of just what value someone wants to, ascertain to it. So I am bullish on it though, right? Like I think whether or not, I don't know if necessarily if even the US, even with everything Trump said, or other countries are going to necessarily, create too much of a strategic reserve. They'll just try to confiscate some of the illegal, ones they've already confiscated and use that as a backing. But ultimately, right, just the pro crypto, the deregulation, the potential of, right, having governments do that is all bullish, right? So I think, again, it goes back to kind of that, animalistic spirits could kick in and could go a little too much. And so if you get in, once things get a little too crazy, you may want to jump back out. But yeah, if it hits $100,000, it's going to get even that much. It's already got tons of media attention. If it hits, $100,000, it's going to create that much more media attention, likely to create that much more demand, and likely to keep going, higher. How high it go, I have no clue, to be honest. To be honest with you, like I said, I would say, don't go crazy with it. It's better to stick with, have a couple percent, or something. That's like what I have, a couple percent in it. I have a couple percent in gold. I'm not a gold bug, but again, I can see why, gold can make sense in certain environments. So that would be my, my professional opinion on it, is that I am bullish, but, if you're more, again, if you're more a risk taker and you think you can kind of play it, do a greater, but that would be my stance for most people. Right. Just do a smaller allocation.
Yeah, and there's other ways to. Oh, go ahead.
Because I think Bitcoin is the talk of the town right now, especially with it. It was approaching $90,000 before today's call. The reason people are bullish on Bitcoin is really in many ways because they're bearish on the dollar, and I think that's one play for some people, is to say, well, I'd rather own Bitcoin than US dollars. And if that's what you believe, it's kind of like you have to go into the whole psychology of what are you owning your Bitcoin for? Are you going to use it to purchase something in the future? Is it just plainly a store of value? And going to Kyle's point of why we don't necessarily take cryptocurrency positions on behalf of clients is in part because of I've always found, for me personally, I'd rather invest in things that create cash flow, and where the understanding of value is the present value of the future cash flow. And so I didn't invest in commodities much either, because for the same reason. And also, I would say that kind of goes back to just being a growth investor and having a growth investor mindset. If you want to buy the hot thing, the question is, well, what's the intrinsic value versus what's the stated value? And maybe there'll always be a difference between the intrinsic value and the stated value, as long as there's enough momentum for the demand to kind of exceed the supply which will drive prices up over time.
Right.
The other thing to mention about cryptocurrency is that one of the other reasons we don't provide it inside of our investment accounts has to do with regulation. But a great benefit of owning cryptocurrency is to be able to store it in a cold wallet where you have your coins on a hard drive that is not connected to the internet. And therefore, we can't participate in that type of transaction on behalf of our clients. And so for clients that want to have a 1% or 2% allocation of Bitcoin, which we think is a totally reasonable thing to do, we would encourage you to put that in cold storage, because then you're getting the safety aspect that Bitcoin does provide. That currency is just much harder to move around. If you physically need to go from one place to another, currency is much heavier than a cold storage wallet.
Right. Thanks for that, Noah. We do have to wrap up here because there's also a giveaway we're going to give the audience here. But just in 20 seconds, Noah, I'm curious now, because a lot of audience members, I'm sure, have children. And if you're listening to the recording, you might have kids. I know we're not actively buying Bitcoin in portfolios due to what you mentioned, but do you think personally it's wise for people to be storing Bitcoin for their kids that are young now?
I think it's, if you're the type of family that maybe had gold passed down from one generation to another, or silver passed down from one generation to another, then Bitcoin's an appropriate similar type of asset. But if you're the type of family that would prefer to pass down assets that are generating income, real estate, publicly traded stocks, bonds, well, the income side will never come out of Bitcoin. And so you can pass on something that is of value, but the only way that your beneficiaries, your children or not, could use that asset is if they sell it. Otherwise, it's just sitting in a drawer.
Yeah. Great. No, that's helpful. Thank you.
And like I said, even if you think of like Bitcoin going from, let's say it hits 90 and it goes to 180, you double your money. Look at NVIDIA, right? That's thousands and thousands and tens of thousands % gain, right? In those type assets, right? You're being exposed to stocks that can compound earnings and compound growth long term. Again, I think those are more hedged, good plays. But investing in kind of the future AI is still not, it's expensive, still not done, right? Like, mega caps are putting a few $100 billion. If the rest of the S&P started putting, the same amount of % of revenue, that'd be $4 or $5 trillion, spent on it. So, right, there's plenty of other opportunities. So stick with a diversification, kind of follow. Don't get too bugger skis on any one thing, but focus on the pro growth areas.
Yeah, and we've definitely seen a lot of that spike with the NVIDIAs and the Teslas. So thanks for sharing that. If we can go to the next slide, please. So for the attendees today, we're going to do a couple things. So we're going to offer a complimentary consultation. Clearly, there's a lot more we could dive into and spend another hour on this call. But what we'll do is if you go to the link right there, you can fill out a form and they'll post it. Our team will post it for you in the chat as well. And you can let us know what is most important to you. If you want to talk about taxes, if you want to talk about your investment portfolio and have Kyle look at it for you, or if you want to talk about potentially selling your business within 4 years, how we can best position it. Because Noah, you spent some time talking about the favorable tax policy. And as a business owner, I might be curious, how can I be advantageous and take advantage of that? Should there be some restructuring that I should be doing from an entity perspective? What are some of the tax cuts that I should be aware of? And if I'm going to get additional tax cuts, what could I be potentially doing with that revenue if I plan on selling my business, or if I'm getting more of that revenue that comes home to me and I can actually invest it in the markets? On top of that, a lot of the policies we spoke about, we packaged for you in a business owner's election guide. So all the policies mentioned are in a guide that will be free for you just as a token of our appreciation for attending. You will see that guide when you fill out the form there. Alternatively, you can just text this number, which is 708-705-0697. Just text the word election and our team will send it to you directly as well too. And they'll post this all for you in the chat, but feel free to just text us directly and you'll get the guide directly as well. Next slide, please. No, I'll pass it to you because we do have an exciting one coming up with holidays. And as entrepreneurs, we always spend time talking about money, money, money. But just as important as making money, it's also about giving back and having value, philanthropy, and just being rich beyond money. And so maybe you can talk about why this is an important talk for you and your connection with our really exciting guest.
Yeah, so Cliff Viner is my philanthropic mentor. We got paired together through an organization that we both supported, and we've had now a long-standing relationship. And he's just a real generous person who sends over 100 kids to college every year. And he created his own charity to do that, his own program. And one of the things we'll talk about is his evolution of giving and how he opted to create his own program from scratch rather than partner with another organization, and the types of things he's done historically when it came to philanthropy and how he decided to allocate his dollars and his time and his network towards different causes. So I'm looking forward to having Cliff on, and hopefully you'll join us. If you want to use your telephone, you could just scan the QR code, or you'll receive a registration link when we send out the recording, along with the similar kind of emails that you'll receive around this topic of being a good giver. And Cliff is a generous and wonderful giver, and I'm excited for what he'll be able to share with you and maybe plant some seeds for you to think through how you could be a more effective giver as well.
Thank you, Noah. I want to thank everyone for attending today, and I want to thank our experts, Noah, Kyle, and Peter, who spent their time navigating the election results with us. And we look forward to seeing you next month for another Thrive Talk. Thank you, everybody.
Bye, everyone.